Hey, this is Dylan Marma. If you want to learn how to use your small axe to build an empire, you should be listening to the Small Axe Podcast with my good friend Nico.
Hey guys, it's your boy Nico here from the Small Axe Podcast. I want to show you how to use your small axe to build a lasting empire. You see, not everybody begins their investing career with millions of dollars, a huge network of investors, or the knowledge necessary to become successful in this space, and that's okay. What I focus on here on this podcast is helping you hone your skills, sharpen your tools to become the best investor that you can be. Now, I want you to sit back, relax, and enjoy this show. If you have any questions or you want to reach out to me or the guest, feel free to do so. Love you guys. All right, Small Axe people, it is your friend, your boy, your pal, Nico, and I'm hanging out today with one of the coolest guys in multifamily. He's doing a lot of different stuff. I'm really excited to talk to him. I met him years ago. This is probably 2019 we connected, and now it's 2024 already. Oh my goodness. So I'm excited to get him on, get his journey, talk about a little bit about what he's doing, what he's up to. Maybe you can follow the blueprint of what he's been doing and learn something from him. So without further ado, Dylan Marma, welcome to the show.
Thanks for having me on the show, Nico.
So excited to have you on, man. I can't believe this is the first time.
I know. Very surprised.
I know. So let's do this. Let's take a couple of minutes to give the listeners some form of a background of how you got to where you are today.
Sure. So yeah, I'm initially from upstate New York. I grew up just with, middle class family, and I thought that I was going to go and pursue sort of a traditional route of going to a state school and then going to work, ideally in New York City, and I was pursuing accounting. And about, I guess, close to 10 years ago now, I had sort of a light bulb moment at a certain point in time where I, realized that I wanted to pursue something a little bit more entrepreneurial, and I kind of just caught that bug. And after a little bit of experimenting and looking around, I sort of set my sights on real estate investing. And I hit a point where I decided to buy a one-way ticket to California, sunny San Diego, picked up, left to go work for, any real estate company at the time that was going to hire me so I could learn the ins and outs of the business. I landed a job in a real estate investing education company that had a bunch of spin-off companies that invested in all different types of asset classes. So I spent a few years there, learned a lot, and then got ready to go full-time. So I've been full-time now for I guess it's been 6 or 7 years, and starting off with sort of a bootstrapping by buying some single families, buying into a 21 unit with a few partners, and then I was able to find some partners that had more experience, and I was able to come in to be the young sweat equity to help find deals, find investors, raise money, asset manage, things along those lines. So really, cut my teeth there, working with some more experienced partners for a few years. And then 2020 hits, and right before COVID hit, we had just hit a point where I think we had different long-term visions, and deals were a little bit slower at the time. So we said, let's go in different directions. And then I broke off and started the Equity Group. And that's when around the same time I caught the bug for mobile home parks. I just saw just a great risk-adjusted return, and think there was a little bit of stigma around the asset class as a whole, and that really created a lot of opportunity, and started investing into MH, and also followed along with RV campgrounds. And today we operate 26, 27 properties, a little over 2,400 units throughout the Southeast. We're vertically integrated. We manage everything in-house. I'm here in Tampa, Florida, as where Nico's well familiar with. We live here in Tampa, manage and acquire properties throughout the Southeast, have a great investor base, a lot of just high net worth individuals that we've built relationships with over the years. So always grateful for them. And, the real estate market is seeing a little bit of turbulence at this time. We're in a really healthy position with, high cash flow, all of our properties distributing. So I'm, overall happy with how it's worked out thus far. So that's where we sit. So that's my 10 years in a nutshell, to the best of my abilities.
No, man, that's incredible. Your story is awesome, man. And you basically do syndications. Is that accurate to say?
Yeah, I think that's accurate.
All right, so you're making distributions. I spoke to some people that invest with you, and they're very happy, which is awesome, and I love to hear that. What do you like attribute that to? Because a lot of people pulled back on it on their distributions, us as well, for the past 6 months or so. However, we're resuming this month. But what do you think that is a factor of?
Yeah, I think in our case, it just really is just has to deal with the asset class that we've been purchasing, right? We've been buying assets that have either a slightly higher going in cap rate or much higher going in cap rate pending the type of asset, and the ability to be able to create additional upside. So the portfolio wide yield on cost ended the year at around 8.5%. So that's our yield on our, not just our purchase price, but all of our CapEx and additional costs that went into the property. So having an 8.5 with, our average debt likely being somewhere in, I would guess, like the high fours, maybe, right? It gives us a really healthy spread, of operating, of just positive leverage. And I think that's giving us that's what's creating, good cash flow. And I think in our case, we have all fixed rate debt. I think a lot of the pause distributions that I'm, seeing and hearing about are a function of floating rate debt. We did have one deal that was floating rate debt out of, our 20 plus loans. We had one that was floating, and we did have to pause distributions for a brief period of time just to be able to, ensure we had the bandwidth to refinance into the fixed. But, thankfully we're through that. So, but yeah, I think a lot of it has to do with just fairly conservative leverage, lower LTV, all the above.
Awesome. Hey, for mobile home parks and RV parks, does agency debt touch that, or do you have to go through local banks? How does that
Yeah.
work?
Yeah. So for, MHC, agency will finance your properties once they hit a certain threshold. You need to have usually below a certain percentage of homes being park owned. You need to have paved roads. You generally could be paved driveways. There's just particular requirements that it has to meet in order to qualify for agency, but definitely does. Our RV does not. So both asset classes, they rely a lot on banks, regional banks, national banks. You also have CMBS options, life insurance options as you get to, larger scale assets. But yeah, the MHC does have agency options.
Cool. And when you're doing your deals, I know that you have deals in various states, but where do you typically focus?
North Carolina is our biggest state. That's really our sort of bread and butter. Tennessee being our second biggest state, and then we have a few that are additional states outside of that, but that's where the bulk of our portfolio is.
And how come?
North Carolina, when we got started off, I was looking everywhere in the Southeast, really, right? And it somewhat was just where fate brought us as we started to find a nice pipeline of opportunities along the coast of North Carolina. So it wasn't this grand decision of, researching the entire, country and finding a place that we had a thesis was going to see more growth than anywhere else. Although it's, turned out really well for us, and we have seen a lot of growth there. And, we like the state. We think there's, a healthy amount of growth, a lot of people moving, to there for the affordability or the weather, whatever it might be. But it just really sort of worked out that way. And I'm a believer in buying the deal, not the market generally, right? So I'm not necessarily building our business off of just, trying to ride the headwinds of the tailwinds of the market, as much as buying, quality deals that are in good markets that, seem to have, that are heading in the right direction. But I'm mainly focused on the asset itself, the potential upside, and then, the strength of the market is, just one of the things that we need to see to be able to pull the trigger.
It's awesome, man. I have some questions about being vertically integrated. I know my listeners understand what that is, but if you're in a different state and you're in multiple states, how does it work and how do you set up shop? Like, let's say you acquired an asset in a different state, maybe Georgia, and now you have to set up a property management team. How does that work?
It's a total headache, and it's just a necessary evil, right? We don't manage to create a big profit stream for our company. We manage because we believe that we're going to do it better and care more than a lot of third-party companies would. If I felt like I could get equal or better results with third party, we'd be there all day. But I think that management. I've done deals with third parties, years ago, and done a lot of deals in house. And I'm just a believer that in the asset class and the deal sizes and the space that we're pursuing, it's what's going to ultimately, reduce the risk the most for the investors, get the best, possible outcome. But it does create a lot of work when you have to, recruit and build, and you have one-off assets that are in states on their own. So you want to be able to start by having your first purchase in any market have enough scale to where you can really build out a team day one. Be very tough to do if you couldn't afford a full-time employee day one. It's very difficult, and it depends on the asset and kind of the business plan.
What size typically, or purchase price, or I guess income, or would warrant hiring a full-time, I guess, would it be a leasing agent and a maintenance person, or what would you hire?
Yeah, it depends on the product type. MH is very different than RV. RV, you generally want to see, I'd say, like $1 million a year in gross income. MH, 500,000 or maybe even slightly less is still, enough to be able to, get the property staff generally, because they do run a little bit more lean. And there's not as much of the hospitality component involved. And then, yeah, I think on the multifamily side, it's probably more common that people look at number of units, but generally at least the 80 to 100 unit mark that's generally where you start seeing people bringing on full-time staff.
Cool, man. So up here in New York, I'm from New York also. We go camping, and there are like RV parks or campgrounds as well. And I love going to these places, but I also see people working there and people taking care of the grounds and stuff like that. How does that work? Do you like take over the business and keep people on staff?
Yeah, definitely. I mean, when we purchase any campground, we absolutely prefer to keep the team on board, and we always generally do. We'd only make changes if it just turns out it's not the right fit. But more often than not, I think we've had good success with keeping the managers on, especially if they've had a long track record. And then, yeah, in terms of building out the rest of the team, we just look at who's there currently and, see how they're running things currently and kind of help it fit into our model. But it's always our preference to be able to work with, the legacy team that, knows the business inside and out. So.
Cool. And when you're like, do you have like a standard like business model of like maybe how long you hold these assets for? Maybe you're modeling in a refinance and getting investors out. Like, how do you look at these deals?
Yeah, so that depends. It's very just deal dependent, and we usually set more of an indefinite timeline where our target is usually to go in, add value, refinance between years 3 and 5, to be able to return capital between both the cash flows and the refinance. Then from there, we'd like to hold for long-term cash flow. But again, that's market dependent. So I think if we're looking at the market and we're seeing, expense growth risk that could, we think we now form the conviction that expense growth is going to outpace income growth in that market, then maybe we would sell, right? Or if we feel like there's just no more meat on the bone, limited growth prospects, at that point, we would likely sell. But if you're in a great market and you see a lot of potential, and you've already gotten the investors their initial capital back, and you're able to continue to cash flow and receive, hold on to the tax advantages that you've been able to pass through, then we continue to hold, right? So it's very deal dependent. We haven't sold anything yet to date. And we're not chasing, we're not the investors that are out chasing IRRs, right? Like we do look at IRR, absolutely, and it factors heavily into our decisions, but we're really more looking at equity multiple, compounding wealth over time, ensuring that we investors get the full tax advantages that are possible through the investments that we participate in, and then looking at the deal. We're not necessarily in the camp of never sell, but we're going to look at it really on a holistic view and see what's the right thing for the asset overall.
So cool, man. I agree with you, and I try to like teach this to people or talk to people about it as well. When you're looking at metrics, IRR is one of them, and that's takes into account the time value of money. So people were pumping up these IRRs, getting 30 plus IRRs from selling within a year or so. When the time was right, a couple of years ago, this is what happened. People bought in 2020, they sold in 2021, et cetera, and they were having huge IRRs, and it looks great on paper, but it's not necessarily the best strategy for everyone. So just something for people to think about out there. I agree with you. Do you have a standard 70-30 split or any certain waterfalls that you bring to every deal, or is it deal dependent as well? And does it change?
Somewhat deal dependent. You generally target around an 8% preferred return and 70-30 or 60-40, with the majority going to the investors on the waterfall. And then, we usually keep our fee structure very simple. A lot of our deals we've done just an acquisition fee, and sometimes we have an asset management fee depending on what needs are. So we usually just try to keep our investor structure pretty simple overall.
I do the same thing. And what I've been trying to consider somewhere down the road, I got to be able to get out of my W-2. So I need more equity, right? And I need more ownership of these deals. And one of the strategies I implemented on my previous smaller deal is like and we wrote this up in the operating agreement in the PPM. So investors understand this. If we are able to refi out 100% of their returns, then thereafter we will do a 50-50 split between the GPs and the LPs, just to kind of help me out a little bit, because I'm putting a lot of work in here and I'm not taking an acquisition fee on that one. I'm sorry, an asset management fee on that one. Again, like you said, sometimes I bake it in there, sometimes I don't, but it's just something I'm trying. I want to see how that goes. And I have a feeling that this one we can do 100% refi.
Nice.
Yeah.
That's great. Yeah. Yeah. I mean, you got to look at the size of the deal, the business plan, and, weigh all of the above in, right? But I mean, we're all about, leaning on the side of investor friendly, and it's certainly a delayed gratification business. But think we're aligned, and I feel like that's somewhat what made it an attractive business for me, because I do a lot of things in my life that way.
I remember, I don't know, a year or two ago, I don't know, you were looking at multifamily and you had a fund set up, or do you still have a fund, or how do you raise capital?
We did a fund, but we've never done a fund, targeting multifamily. We definitely were looking at multi, and we have looked at a lot of deals in the last few years, but we just haven't found anything that we've been able to connect on.
No, I hear that.
But it's been tough. But we have done two smaller funds, $10 million funds that were deployed over a few different smaller assets throughout the Southeast. So we went with that model, but right now we're going deal by deal. It's tough to find deals, tough to find anything that makes sense. We want zero pressure to force a deal in this environment. So I would only consider a fund again if we saw a really big opportunity to fill up a big pipeline of very, very attractive opportunities. And I mean, right now I'm maybe saying yes to one in every 200, 250 opportunities that come across our desk. So it's been certainly slower. So I don't think it'd be an opportune time to be sitting on a fund. However, things could change very quickly, right? And that's where those that do have funds in place will see the advantage of that.
Yeah, I totally hear it. Do you underwrite all your deals? Do you have somebody doing it for you? What does your day look like?
Yeah, we have like a 3-step process. So we have one guy that does the initial, data entry piece. Then our acquisitions guy takes over from there, and tidies it up, and then jumps on with me at a point to do a final review and decision making. So that's how we're able to look at so many deals without spending countless amounts of time. And my day is all over the place. Probably operations definitely is, I would say, at least 50% of the day, be it financial operations or property management, a lot of time spent on that sort of thing. Acquisitions is probably the next largest chunk. And then, investor relations is really not that time consuming unless it comes in waves, right? If we're in the middle of a capital raise, there could be a lot of questions and investor communication going on. But it usually is just more so like end of the quarter pouring into, doing really thorough quarterly reports and ensuring questions are answered through that format. And that usually helps, really keep investors happy and keeps things moving along. But I'd say, operations probably the biggest, followed by acquisitions, and it can always ebb and flow, right, depending on what's going on. So every day's different.
Busy man. I hear it. I appreciate your time today. Dylan, let's give the listeners some sort of nuances, because I have people that are interested in mobile home parks and RV parks. I remember I looked at a few with you too. I'm just not knowledgeable enough, and you helped me significantly with like small conversations. So if somebody's looking at a mobile home park, maybe a couple of tips of what they should be looking for or not looking for.
Man, it's tough. Yeah, I mean, maybe start close to where you are if you're going to manage it yourself, or if you're looking for third party, you have to probably go for a big enough asset to be able to, afford a quality third party operator. So I would start with maybe thinking about operate it, and then also, of course, you got to start thinking about how you're going to capitalize it, right? How much money do you have? How much money can you bring in? Are you raising money? And so on. So I think once you have that narrowed down, you can kind of figure out location and deal size. And yeah, I think just knowing the operational intensity of it, right? Like how much are you willing to roll up your sleeves and do some heavy lifting? Because there could be some great deals out there if you're really willing to get your hands dirty. But if you're taking on stuff that has heavy infill, private utilities, especially if they're not in the best shape, rougher tenant bases, like that stuff is very, very far from passive. And you've got to make sure you're buying it right and, being conservative on your costs, which is the tough part when you're new because you're not ultra familiar with all those costs. So I think just, really getting clear on what do you want first, and then, it makes it a little bit easier to determine if it makes sense to be an active investor or just be a passive investor, right? Because I think I think if you do a lot of hunting, you can find great deals actively. But I think, for most people, if they're not really willing to put a ton of time in, it makes more sense to be a limited partner on these things because of, the complexity of it. So that'd be my take.
Oh man, I love it. Real quick, the last thing that I look at when so I don't look at mobile home parks. However, when they come across my table, I take a quick look at what the OM looks like, and a lot of times the broker will put on there tenant-owned properties or tenant-owned homes. Is that better or worse than and they seem to make it a big deal. What I thought the opposite was better, but I don't know. Is it better to have tenant-owned or park-owned?
Oh yeah, definitely tenant owned. Because that's the beauty of the business, is that once you're able to sell the home to the tenant, or once the tenant owns the home, generally they stay there for an average of 15 to 20 years, versus a park owned or an apartment, they stay there for what, 2 years on average, right? So you have way lower turnover, and then they are also responsible for the upkeep and the maintenance of the home. So your CapEx decreases dramatically. So you have, a super long duration stay from your residence. You have minimal ongoing CapEx because you own minimal physical structures and you really just maintain the roads and the landscape and the community itself. And that leads to, extremely durable stream of income. And that's the reason that any, MH REIT, in terms of the NOI growth year over year, has outperformed so many other asset classes, just because of the sort of the fundamentals. And then the supply demand piece of it is just amazing too. Not to go on a tangent, but they're not building more of these. It's very rare they are, and usually there's more getting torn down than there are going up. So you have just that's a great part of the story as well, is that this is not something that financially makes sense to build in most markets. So you're really well insulated from competition as a result.
Oh, awesome advice, Dylan. Thank you so much. So I'm going to be mindful of your time. We're going to wrap it up, but I have one final question. This question is a doozy, man. Let's see if you got it. Let's imagine it was 100 years from now. You have great grandchildren and they wanted to write a book about you. What would you want them to title this book?
I'd I'd go with I'd go with compounding. I'd go with compounding to only because the compound effect is taken. But I think that I think a lot of the way I look at a lot of things in life is just, the small things you do each and every day, really add up, and will compound over time. And I'm just a huge believer that we have to be really thoughtful on what we're spending time on and investing time into, and watching those results sort of exponentially grow over time. So that would be my title.
I love it, man. Thank you, Dylan. All right, let's get the listeners some form of contacting you or reaching out to you.
Yeah, you can follow me on LinkedIn. Is probably the social I'm most active on. If you want to search me up on there, and if you want to go to our website, you can visit requitygp.com. That is REQUITYGP as in general partner.com. And you can opt in to join our investor list there if you'd like. And we send out quarterly newsletters and occasional opportunities when they pop up.
Oh, absolutely. Hey, people listening, go sign up for that. Be a passive investor with Dylan. He's making distributions throughout this time. An awesome asset class to be involved with, and an awesome operator. Dylan, thank you so much for joining me today.
Thanks a lot, Nico. It's great to be on the show. Appreciate it.
All right. Hey, Small Axe community. I would like to say thank you for listening to another episode of my podcast where we show you how to use your small axe to build a lasting empire. Now, if you liked what you heard, it would mean the world to me if you would subscribe, leave a 5-star rating, and write a review. Also, if you want to get in touch with me, go to my website at smalaxecommunities.com. Book a call with me. And until the next episode, keep sharpening those axes.